Welcome. My guest is tax law expert Robert W. Wood, writing frequently in Forbes, as he does, and he is a principal at Wood LLP in San Francisco. We're going to discuss an article regarding gift tax and real estate deeds. Welcome back, Rob.
Thanks. Good to be here.
You know, we talk about gift tax periodically and how it applies, you know, especially in estate planning, but we always assume that's the hardest tax to collect. Because a gift is something that you can do without much scrutiny by the IRS. But the IRS is taking extra steps here in the world of gifting property, for example, and they're taking an extra step in mining deeds to find out what's exactly going on. This is sort of unprecedented, isn't it?
It is, and I have to say, when I wrote about this in Forbes, I got some emails from people saying that, you know, don't worry about this, and from practitioners. I mean, I think there's some controversy, but I think, as you said, it's unprecedented. I think the IRS is, you know, notwithstanding the very favorable changes in the gift and estate tax law for 2011 and 12, the IRS is taking steps to see who is making gifts and who's signing over property to little Johnny or somebody else, and are they filing gift tax returns, and if so, are they appropriately reporting value, and those sorts of things. So while you're correct, Scott, that the gift tax is historically very hard to collect, I think that looks like that's changing.
And how does the IRS go about investigating some of these deeds? Is this sort of a random kind of sample that they do here, somewhat like an audit, or are they just wholesale, just trying to dig up as much possible revenue as they can?
Well, I think the latter. I mean, I don't know, and the IRS is fairly guarded about releasing, you know, that kind of data. So I don't know what their methodology is. But I think the main thing is that, you know, we talk on the Legal Broadcast Network a lot about lawsuits and settling lawsuits and that kind of thing. And I find that clients and lawyers are sometimes surprised to learn that the IRS sometimes audits plaintiffs who receive big verdicts. You know, it's not necessarily because there was a 1099 for the payment. Sometimes it's simply the IRS read about it in jury verdicts, or the newspaper about a verdict, or a settlement for that matter. So this is the same kind of thing. It's the IRS using information it can find.
So let's again maybe revisit what exactly the estate and gift tax requirements are. I mean, we have a nice option here until the end of next year, which has a $5 million allowance, but that's not something you can just depend on without filing, because there's a pretty low threshold of about $13,000 for an individual gift, isn't there?
Yeah, that's right. And I mean, first of all, you bring up a couple of good points. One, I think the gift and estate tax world is still up in the air, and although many people have forgotten that this is only a 2-year patch, that is, as you say, it's a $5 million for gift or estate tax combined, which was a terrific change, but it's only for 2011 and 12, and so we don't know what's going to happen. But I mean, the other point you make, Scott, is the threshold for what's a gift is very low. $13,000 per person per year is the annual exclusion gift, and anything over that must be the subject of a gift tax return. So if you're eating into your $5 million, you need to report it. You need to file a gift tax return. And I mean, one good thing, incidentally, about filing gift tax returns is that they are historically rarely audited, and you get the statute of limitations running. Statute of limitations for tax purposes, another thing we talk about a lot here, generally speaking 3 years, and you want those 3 years to expire so the IRS can't come back and challenge it.
I guess finally in conclusion, I guess if you're talking about property in a lot of ways, a lot of the value, you know, has changed dramatically in the past few years. How does the IRS look at that? How do they treat the valuation of property?
Well, I mean, it's a factual question, and so and I guess, classically, people value different assets, but real estate is probably the most obvious one that needs to be valued. And if a transfer is occurring in a market sale, by unrelated parties, I suppose you could say there's not much reason to value it. I mean, the purchase price is the value. But if it's a gift to little Johnny or somebody else, or sometimes it's a bargain sale, it's a sale but not at fair market value, I mean, then you do need to have a value, and you shouldn't just pick one. If there's any significant money involved, the IRS can and often does dispute the value, so you want to get a good and solid appraisal.
You can find Rob Wood as the tax lawyer in Forbes, and he is principal at Wood LLP in San Francisco. Thanks, Rob.
Thank you.
And thanks for watching.